hope you all are doing well. The subject which I am going to teach you is banking and financial institution, which is going to be helpful for all the commerce students, including the students who are preparing for the NET JRF. In this video, we will learn about the financial system in India, its features and objectives. As we all are aware of importance of money in our life, in order to earn a decent living, we all need money. The world is divided into two groups of people. One is known as savers and the another is known as investor. Savers are those people who have money but no opportunity through which they could put that money for better purpose. And the another group is which is known as investors are those people who have the opportunity and enough potential to convert that opportunity into profit. But the only problem is that they don't have any money. In order to solve this problem, we needed a system through which the investors could get that money which are kept somewhere in someone's house and utilize that and make investment and earn profit on that. And that's where financial system comes. Financial system is a set of institutions such as banks, insurance companies and stock exchanges that facilitate the flow of funds in the country. It provides a platform and link the savers and investors and enable them to exchange funds. It helps to create wealth by providing interest to savers on their deposits and investment and help the investors to earn more profit. In this diagram, the surplus unit is known as savers and the deficit unit is known as investors who are in need of money. The surplus unit or the money is transferred from surplus unit to deficit unit through two means, that is market and intermediaries. Intermediaries are the banks where the surplus unit or the savers deposit their amount or money in the banks, which the bank further lend it to the borrowers. And with the help of market, the deficit unit could raise the funds from the savers through investment. This shows how the banks work, where the savers deposit their money in the bank on which they get a certain amount of interest on their deposit, and the deposit which the savers have deposited, the banks further lend it to the borrowers on which the bank get paid a certain amount of payment as interest from the borrowers. It is kind of win-win situation for both the parties because the savers who has enough money but they could not raise that money or increase the value of that money, but with the help of financial system they could earn interest on their money on their savings. And the second group of people which are investor, they needed money but has no means, and financial system helps them to provide that money which they needed to earn more profit. Moving to the features, the first point is it plays a vital role in the economic development of the country as it encourages both savings and investment. As the savers get paid interest on their deposits and investment, it encourages them to make more saving and investment in the futures, which helps in the economic development of the country. Next is it helps in mobilizing and allocating one's saving. With the help of financial system, the savers amount is being transferred to the investors and allocated according to their need. Next is it facilitates the expansion of financial institutions and markets. As more and more people connect to the financial system, it broadens the scope of financial institutions and markets. Next, it helps form a link between the investor and the one saving. The financial system provide a platform and create a link between these two group of people so that they could help each other. The last one is it plays a key role in capital formation. In order to understand this, we first need to know what is capital formation. Capital formation, as the word suggests, means formation of capital, that means creation of capital. It means addition to the current stock of capital. But there is one thing which we need to know is that here capital doesn't mean money capital, but it actually refers to increase in physical capital, that are machinery, factories, transport equipment, bridges, power projects, dams, irrigation system, factories, tools, etc. These are capital goods which are used for future production of goods or commodities. For example, a company running clothing factory has up-to-date machinery and tools, but there is going to come a time when those machineries would be needed to replaced. But what happens when there is no machinery available in the market? Why? Because the companies who produce these capital goods have no fund to continue their business. You know what going to happen? It is going to disrupt the entire production function in the country. That's why the financial system helps them to provide the funds so that they could keep producing and keep continuing their business, which helps them to create more capital. Process of capital formation. It, it has three stages through which the capital could be forming. The one is creation of savings, mobilization of savings, and the investment of savings. With this process, the money from the savers is transferred to the investors with the help of banks and financial institutions. These investors use that money in producing these capital goods, which helps them to create more capital. Now, moving on to the objectives. First one is to provide a payment system. Money as currency could be easily used for the payment between individuals, but when it comes to the banks, businesses, and other organizations such as governments, it is not possible because they are required to pay out a large amount of money. The financial institution or the banks helps them to quickly transfer the money, and not only that but also helps to record the transaction which could be used for the accounting and tax purposes. For example, during the COVID-19, the UP CM Yogi Adityanath announces to provide 1000 rupees to the daily workers. Now, it is not possible to hand over money to each and every workers, but with the help of banks, it was transferred to their account. It was directly transferred to their account, and not only that, their records was also kept, which provides that who get the money and who did not. Next is to give time value to money. Unless and until the money is put to use, the value of the money could never get increased. With the help of financial system, it provides and add the value to the money as the time passes. For example, you have 1000 in your wallet, but if you check that money in the next 1 month, it is going to be the same as it was before 1 month. But if the same amount is deposited into the bank, it is going to add interest as the time passes, which provides, or could be said, add value to the already existing money. Next is to offer products and services to reduce financial risk or to compensate risk taking for desirable objective. Financial risk means risk of losing money. As we pay out money in hope to gain more in the future, there is always a possibility that we would never be able to get that money back. But financial systems offer various products and services which assures and also reduces these risks of losing money. For example, insurance companies. Insurance companies offers various kinds of insurance scheme to their clients, which offers to provide protection against the probable losses. Next one is to collect and disperse information that allows the most efficient allocation of economic resources. When we decided to invest our money in the market, we need various kind of information which is going to assess to make a sound judgment regarding our investment. And the financial system helps to provide these information, which include the information regarding companies, contract, the availability of various kind of instrument in the market. Also, it provides current market information. With the help of these information, the investors can assess the performance of their investments. For example, credit rating agencies. These agencies rate the credit of companies and other organizations that issue bonds. With the help of these credit agencies, the investors could know the credibility of these companies before making an investment in their company. The next is to create and maintain financial markets that provide prices which indicates how well investments are performing, determines the subsequent allocation of resources. The stock prices of companies change from time to time. The organized exchanges provide current prices on stocks and other assets of every company listed in the market. This helps the investors to know how their investments are performing. The last one is to maintain economic stability in the market. The financial system manages the flow of funds in the market, which helps to stabilize the economic condition in the market. For example, the companies or businesses who have lack of credit would eventually lead them to shutting off their businesses, which is going to create the problem of unemployment and also going to reduce the tax receipt of government, which is the source of revenue for them. And then what going to happen, the government are going to cut their spending and also the raises the tax rate in the country, which is eventually going to hurt the people. So in order to maintain the economic stability in the market, the financial system manages the flow of funds in the entire country. Thank you for watching the video.